When famous names start throwing out big silver numbers, it's never random. Robert Kiyosaki talking openly about triple-digit silver in 2026. JP Morgan recalibrating targets they held for years. Institutional forecasts scattering from $41 all the way to $200. That spread is not noise, it's a warning. Because when predictions stop clustering, when respected institutions look at the same market and see completely different futures, something critical is happening beneath the surface, and most people won't see it until it's too late. Welcome to Currency Alert. If you've been watching markets long enough to remember when things move for reasons, not just headlines, then you already know why you're here. We don't do hype, we do clarity. And if that matters to you, hit that subscribe button like you'd close a position that's working. Quietly, decisively. Because what we're about to break down doesn't show up in your social media feed. Also, drop a comment and let us know where you're watching from. We track these signals globally, and we want to know which corner of the world is paying attention. Now, let's get into what these silver predictions actually mean. When major financial figures begin attaching large numbers to silver, the timing is never accidental. It happens at very specific moments in a market cycle. Right now is one of them. Robert Kiyosaki discussing triple-digit silver in 2026 is not occurring in isolation. Neither are the aggressive outlooks coming from analysts who were cautious just 12 months earlier. The way silver is making headlines at the start of 2026 is not coincidence. It is timing. By mid-January 2026, the silver market already knows what it accomplished last year. The breakout is old news. The shock has worn off. What is not settled yet is what that breakout actually means. That is why predictions are getting louder now, not earlier. Big forecasts do not usually appear at the beginning of a move. They appear after a move forces everyone to recalibrate. Silver did not just rise in 2025, it forced belief. A market that forces belief becomes dangerous because belief is sticky, and silver is not. The danger today is not missing upside. It is assuming the path forward will resemble the path behind. That is where people get hurt. Last year, silver was climbing out of neglect. This year, it is operating under a spotlight. That changes everything. When silver spent years trapped under old resistance, participation was selective. Now participation is broad. Retail investors are back. Institutions have adjusted their allocations. Public figures are comfortable attaching big numbers to the metal. Every one of those adds demand. Every one of those also adds fragility. This is the part most forecasts do not talk about. When a market breaks out after a decade of compression, it does not immediately become stable. It becomes sensitive. Silver right now is not weak. It is reactive. That reactivity is what makes bold predictions dangerous if misunderstood. A $100 or $200 price target sounds directional, but it says nothing about volatility, drawdowns, or timing. Silver does not move in smooth trends after explosive years. It moves in bursts, fast up, fast down, then sideways longer than people expect. This is why January feels different from December. In December, silver was still being talked about as an event. In January, it is being treated as a baseline. That transition is subtle but critical. Once people accept a higher price as normal, they stop managing risk the same way. They assume dips are temporary. They assume patience solves everything. Silver punishes that assumption. After a 147% year, the market is not asking whether silver deserves higher prices. That argument has already been won. The market is asking whether positioning has outrun balance. That is a structural question, not a narrative one. Supply deficits did not magically resolve at the start of 2026. Industrial demand did not slow down. Solar, electrification, advanced electronics, and data infrastructure are still pulling metal. Those forces matter, but they do not prevent volatility. This is where clarity must temper optimism. Silver's fundamentals can remain strong while price behavior becomes hostile. That is not a contradiction. That is how pressure markets behave. Think of silver like a system under load. As long as pressure increases gradually, it holds. When pressure rises too quickly, the system shakes. Last year added pressure from demand. This year adds pressure from expectations. Expectations are heavier than demand. They change behavior. When famous personalities predict big upside, they do not just influence belief, they influence positioning. More people step in, more leverage appears, more assumptions get priced in. That is when silver becomes unforgiving. Not because it cannot go higher, but because it will not carry everyone there comfortably. This is why the risk profile today is not the same as it was 12 months ago. Last year was about recognition. This year is about digestion. Recognition lifts price. Digestion tests holders. Silver is now in the testing phase. That does not mean forecasts are wrong. It means forecasts are incomplete. They describe a destination without acknowledging the terrain. And silver's terrain in early 2026 is uneven. Some participants are well capitalized. Some are stretched. Some entered late, convinced the move must continue immediately. Silver treats those groups very differently. This is why pullbacks feel sharper now, why rallies feel less stable, why price action can look contradictory. The market is not confused. It is sorting out who belongs in the trade and who does not. This is where many investors make the mistake of equating long-term belief with short-term exposure. They hear bullish forecasts and assume time will smooth volatility away. Silver does not smooth. It compresses, then releases. That behavior does not stop just because supply is tight. In fact, tight supply often amplifies it. When inventories are constrained and liquidity thins, price has less room to absorb shocks. Moves overshoot. Corrections sting. That is what early 2026 is revealing. The market is not deciding whether silver belongs higher over time. It is deciding how much excess must be cleared first. That excess lives in positioning, not in vaults. Silver has already proven it can move. Now it is proving how sharp it can be. That is the warning. Not panic, not exit, awareness. Because the next phase of silver's market will not be decided by headlines or forecasts. It will be decided by how the market handles pressure. And that brings forward the next question. If famous predictions are raising expectations, and if silver is now operating as a pressure market rather than a breakout candidate, then how should institutional forecasts and big price targets actually be interpreted? Once predictions start circulating, the natural instinct is to compare numbers. Who is bullish? Who is conservative? Who sounds confident? That is exactly what is happening now in silver. Banks, research houses, and analysts have updated their outlooks after 2025's breakout, not because they want attention, but because the old models no longer fit. Silver did not behave the way it was supposed to. That forces recalibration. Look at the range of forecasts now being discussed for 2026. Some institutions still see silver in the 40s, others push toward 60 or 70. Independent analysts talk openly about triple digits. That spread is not noise, it is a signal. When forecasts cluster tightly, markets are stable. When forecasts scatter, uncertainty is rising. Silver is in the second category. This is where the warning becomes more specific. Institutional forecasts are not promises. They are scenarios. Each one assumes a different mix of conditions, different growth paths, different policy outcomes, different investor behavior. The problem is not that these forecasts exist. The problem is how they are interpreted. Most people treat them like destinations. Silver will go there. Markets do not work that way. Forecasts do not tell anyone how price behaves under stress. They do not tell anyone how silver reacts when positioning gets crowded. They do not tell anyone what happens when volatility spikes. And silver, more than most assets, is shaped by those things. The data makes one thing clear. Silver's fundamentals are not thin. Industrial demand is real. Supply constraints are persistent. Deficits are not theoretical. Solar alone now consumes more than a quarter of annual silver supply. Electric vehicles are increasing silver intensity per unit. Advanced electronics and artificial intelligence infrastructure are pulling demand forward. That is not speculative demand. That is functional demand. But here is the warning most bullish narratives skip. Industrial demand is steady. Markets are not. Factories buy silver methodically. Traders do not. When silver prices surged in 2025, they did not just reflect consumption. They reflected positioning. Exchange-traded fund flows reversed. Futures volume surged. Retail participation expanded rapidly once key price levels broke. That participation does not disappear just because the calendar changes. It has to be absorbed. This is why silver enters 2026 in a different state than it entered 2025. Last year, silver was undervalued relative to its fundamentals. This year, silver is fully valued and then some relative to expectations. That is a subtle but critical shift. When a market is undervalued, good news lifts it easily. When a market is fully valued, good news must exceed expectations just to hold price. That is where volatility comes from. This is also why some institutional forecasts remain cautious even while acknowledging strong fundamentals. They are not denying demand. They are accounting for digestion. After a 147% move, silver does not need more buyers. It needs balance. Balance takes time. The evidence points to multi-year supply deficits continuing into 2026. That is supportive, but supply deficits do not prevent pullbacks. They shape recoveries. This is where many investors misread the signal. They see deficits and assume downside risk is limited. In silver, downside risk is rarely limited in the short term. Silver's market is smaller than gold's. Liquidity is thinner. Price reacts faster. That is why silver historically moves roughly 1.5 to 2 times as much as gold in either direction. That characteristic does not disappear in bull markets. It intensifies. So when forecasts move higher, they do not just reflect optimism. They raise the stakes. More people step in expecting continuation. More leverage enters quietly. The system becomes less forgiving. This is why some analysts who are bullish long-term still warn about consolidation. They are not contradicting themselves. They are respecting silver's mechanics. Another key detail is mining supply. Silver production has not surged to meet demand. Most silver comes as a byproduct of other metals. That limits responsiveness. Even at higher prices, new supply takes years to materialize. That is supportive long term. But again, it does nothing to smooth price action today. This is why silver behaves like a pressure system. Demand pushes from one side, supply resists from the other, positioning amplifies everything in between. When pressure builds gradually, silver trends. When pressure builds quickly, silver snaps. The forecasts for 2026 are built on structural arguments. Those arguments are valid. What they do not capture is how silver behaves when too many people believe them at once. That is the risk phase. This is also why comparisons to earlier cycles matter, even if the conditions are different. In past silver bull markets, the most painful drawdowns did not happen at the beginning or the end. They happened in the middle, right after the market convinced people the move was real. That is where silver is now. Analysis shows that many professionals expect consolidation before the next major leg. That is not weakness, that is process. But consolidation in silver is rarely gentle. It often looks like confusion. False starts, sharp drops that feel unjustified. They are not unjustified. They are clearing mechanisms. This is why forecasts should be read as ranges, not targets. A projection of $60, $70, or even $100 does not mean a straight path. It means a zone that could be reached under the right conditions. Between here and there, silver will test patience. This is where the warning must be clear. Silver's bull case is not invalidated by volatility, but volatility will punish anyone who treats forecasts as guarantees. That is the difference between understanding silver and believing in it. Belief does not protect capital. Structure does. And structure is what the market is testing now, which brings forward the next layer. If industrial demand and supply deficits support silver long term, and if forecasts are expanding expectations, then where exactly does risk concentrate in early 2026? By January 2026, the most important signal in silver is not price. It is disagreement. When respected institutions and public figures look at the same market and arrive at radically different conclusions, that tells something important. It tells that the market is no longer anchored. And look closely at the range of silver price predictions now circulating. On the conservative end, the World Bank still sees silver around $40. That is barely above levels silver already left behind. JP Morgan moves higher into the high 50s. Saxo Bank and Citigroup cluster around 60 to 70. HSBC sits just under 70. Those numbers are not extreme. They assume continuation, not acceleration. Then the tone shifts. Independent research firms start talking about 75, then 88, not next month, but over the next couple of years. And then there's Robert Kiyosaki, $100 to $200 in 2026. That is not an incremental adjustment. That is a different narrative entirely. This spread is not accidental. It reflects two competing views of silver. One view sees silver as a commodity that is already repriced and now needs to consolidate. The other sees silver as a monetary asset on the edge of something much bigger. Both views can be internally consistent, but they create very different behaviors. This is where risk concentrates. When price targets cluster tightly, markets move methodically. When targets scatter this widely, markets become unstable. Why? Because participants are no longer aligned on time. Some are positioning for modest gains over 12 months. Others are positioning for exponential moves in a matter of quarters. That mismatch creates friction. Friction creates volatility. This is where many investors misunderstand what these prediction tables actually mean. They read them as probability rankings. Who is more likely to be right? That is the wrong question. The right question is what these forecasts do to positioning. When institutions publish moderate targets, they tend to attract slower capital, pensions, allocators, risk-managed flows. When public figures publish extreme targets, they attract fast capital, retail money, leverage, momentum chasing. Silver reacts differently to each. Slow capital stabilizes price. Fast capital destabilizes it. The problem in early 2026 is that both are arriving at the same time. That is rare. In 2025, silver was still climbing into recognition. In 2026, silver is being pulled in opposite directions. One group wants consolidation, another wants acceleration. Silver cannot satisfy both simultaneously. This is why the warning matters now. The presence of $100 to $200 forecasts does not automatically mean silver is about to explode higher. It means expectations have stretched beyond structure. That stretch is where damage happens. Think of silver like a rope under tension. Moderate forecasts pull gently. Extreme forecasts yank hard. If the rope is strong enough, it holds. If not, it snaps back violently. That snapback is volatility. This is not a criticism of bullish views. It is a recognition of mechanics. Silver's market is small compared to gold. Liquidity is thinner. Reactions are faster. When aggressive expectations meet a market still digesting a historic rally, the result is instability. This is why even analysts who are bullish long-term still warn about consolidation phases. They are not contradicting the upside case, they are acknowledging silver's nature. Another important detail in the prediction pattern is timing. Most institutional forecasts target 2026. Some extend to 2027 or 2028. That tells something else. Even the bullish professionals do not expect silver to move in a straight line. They expect time to be part of the process. The only forecasts that compress time aggressively are the most extreme ones. That compression is seductive and dangerous. It encourages people to ignore drawdowns, to add exposure at the wrong moments, to confuse belief with risk management. This is where silver punishes. Silver does not reward impatience after big years. It exposes it. This is also why the gap between $40 forecasts and $200 forecasts is not just about price. It is about philosophy. Is silver primarily an industrial metal with cyclical constraints, or is it a monetary asset on the verge of remonetization? The market has not decided yet, and markets that have not decided swing harder. This undecided state is what makes silver risky in early 2026, not because one side is wrong, but because both sides are acting at once. This is why price action can feel chaotic. One day, silver trades like a commodity. The next day, it trades like a currency hedge. That dual identity has always existed. But after 2025's rally, it is more pronounced. This is also why relying on a single forecast is dangerous. Forecasts do not account for who else believes them. They do not account for crowding. They do not account for leverage. Silver reacts to those things immediately. This is where clarity must override excitement. The prediction table should not be read as a roadmap. It should be read as a stress map. It shows where expectations are building and where disappointment could hit hardest. The widest gaps are where volatility concentrates. Right now, that gap sits between moderate institutional targets and extreme public forecasts. That gap is the danger zone. This does not mean silver cannot reach high levels over time. It means the path will be uneven, and uneven paths punish those who assume smoothness. Historical patterns confirm this behavior. Markets that price violently require extended periods to rebuild stability. Silver in 2026 is displaying all the characteristics of that rebuilding phase. Sharp movements in both directions. Disconnection between headlines and price action. Sudden reversals that appear without obvious catalysts. These are not signs of weakness. These are signs of rebalancing. The market is mechanically separating committed participants from speculative ones. That separation process does not announce itself. It reveals itself through stress. And stress is exactly what scattered forecasts create. When one group expects $60 and another expects $200, the middle ground becomes a battleground. Every rally gets sold by those who think it is already stretched. Every dip gets bought by those who think it is a gift. Neither side wins immediately. Both sides experience pain. That pain is the cost of disagreement in a market with limited liquidity. This is the final piece many overlook. Silver's liquidity cannot absorb conflicting conviction without consequence. The metal trades in a market too small for the size of expectations now attached to it. That mismatch between market size and expectation size is where the real risk lives, not in fundamentals, not in supply, in structure. Which leads to the critical question. If expectations are stretched, if forecasts are scattered, and if silver's structure amplifies volatility, then how should someone actually navigate this market in 2026 without getting trapped? By the time silver reaches this stage in a cycle, the most dangerous mistake is false certainty. Not pessimism, not optimism, certainty. That is what breaks people in volatile markets. As 2026 unfolds, silver is no longer proving its relevance. That debate is over. The question now is how silver behaves under pressure. And pressure is building from multiple directions at once. On one side, industrial demand continues to act like a slow, steady engine. Solar manufacturers do not pause because price is volatile. Electric vehicle production does not slow because futures swing. Data centers do not wait for technical pullbacks. That demand is structural. It is persistent. On the other side, financial demand is reactive. It moves with headlines, expectations, and positioning. That combination is powerful. It is also unstable. This is why silver in 2026 is not a simple continuation story. It is a balance problem. Too little demand and price stagnates. Too much expectation and price snaps back. Silver sits between those extremes. This is where many people confuse bullish with safe. Silver can be bullish and still hurt investors. That is not a contradiction. It is a warning. The market right now is not fragile because fundamentals are weak. It is fragile because participation has expanded faster than discipline. After a 147% year, silver attracted attention that did not exist before. That attention does not leave quietly. Some participants are long-term holders. Some are momentum-driven. Some are highly leveraged. Silver does not differentiate emotionally. It differentiates mechanically. When pressure increases, it exposes weak positioning first. This is why early 2026 will likely continue to feel uncomfortable. Rallies may be sharp, pullbacks may be sudden, price may feel disconnected from headlines. That is not dysfunction, that is digestion. Markets that reprice violently need time to rebuild balance. Silver is doing that now. This is also why focusing on exact price targets can be misleading. A $100 silver price is possible under certain conditions. So is a long period of consolidation before that happens. Both can be true. What matters is not the destination alone. It is the path, and silver's path is rarely smooth when expectations run ahead of structure. This is where discipline becomes more valuable than conviction. Understanding silver's dual role matters more now than ever. It is not just an industrial input. It is not just a monetary hedge. It is both. That dual identity is what gives silver upside potential. It is also what amplifies volatility. When economic growth expectations rise, industrial demand supports price. When financial stress rises, monetary demand supports price. But when both forces act at once, silver does not glide. It jolts. That jolt is what many people underestimate. This is why some of the most experienced analysts emphasize flexibility over forecasts. They are not abandoning the bullish case. They are respecting silver's behavior. The biggest mistake in this phase is treating silver like gold. Gold absorbs stress. Silver reflects it. Gold smooths volatility. Silver magnifies it. That is not a flaw. That is its nature. As 2026 progresses, the most important signals will not come from predictions. They will come from behavior. How does silver react to rate decisions? How does it move during geopolitical shocks? How does it respond when inventories tighten further? Those reactions matter more than any single forecast. Silver does not announce its next move in advance. It reveals it through stress. That is why this phase demands awareness, not excitement. Not because silver's story is ending, but because it is maturing. Markets punish those who arrive late and impatient. They reward those who understand the terrain. Silver's terrain in 2026 is uneven, pressurized, and fast-moving. That is the reality. Not collapse, not guaranteed riches. Reality. And with that clarity established, it becomes necessary to address the questions people keep asking across platforms. Question 1. Will silver prices really hit $100 in 2026? There's a plausible path to triple-digit silver, especially given continued supply deficits and strong industrial demand. Analysts like Alan Hibbard believe silver could trade above $100 if these pressures intensify. However, reaching that level would likely involve significant volatility along the way, not a straight upward move. The path matters as much as the destination. Question 2. Why did silver rise so fast in 2025? Silver surged from under $30 to above $70 due to a combination of record industrial demand, shrinking inventories, and a fifth consecutive global supply deficit. Safe haven interest and expectations of Federal Reserve rate cuts also accelerated the move. It was not a single catalyst. It was a convergence. Question 3. Is industrial demand really driving the silver bull market? Yes. Industrial uses now account for more than half of global silver demand. Solar, electric vehicles, advanced electronics, and artificial intelligence-related infrastructure continue to increase silver consumption. This makes demand more structural than cyclical. The industrial case is not speculative, it is measurable. Question 4. Is there still a silver supply deficit in 2026? The silver market remains in a multi-year structural deficit. Demand exceeded mine supply by roughly 160 to 200 million ounces in 2025. Limited new mining projects suggest the deficit could persist into 2026. Supply does not respond quickly to price. Mining silver is not like turning on a tap. Question 5. What are the biggest risks that could push silver higher in 2026? Potential catalysts include further Federal Reserve rate cuts, currency weakness, geopolitical disruptions, and supply interruptions in major mining regions such as Mexico and Russia. Any combination of these could amplify investment demand on top of already strong industrial consumption. Risk does not only mean downside. In silver, risk can also mean violent upside. With those questions addressed, the framework becomes clearer. Silver in 2026 is not a market for casual conviction. It is a market for informed caution. The fundamentals support higher prices over time. The structure warns against complacency in the short term. Both statements are true simultaneously. Those who navigate silver successfully in 2026 will not be the ones with the boldest predictions. They will be the ones who respect the terrain, who understand that digestion follows breakouts, who recognize that volatility is not a malfunction. It is the mechanism. Silver does not owe anyone a smooth ride. It never has. And in a year where expectations have stretched this far beyond anchoring, the ride will be anything but smooth. That is not a reason to avoid silver. It is a reason to approach it with clarity. Because clarity, in a market as reactive as this one, is the only real edge left. If this breakdown helped bring that clarity, then the work has served its purpose. Subscribe to Currency Alert if strategic economic analysis matters more to you than headlines. Drop a comment below with where you are watching from. The world is paying attention to silver right now, and we want to know which corner of it you are observing from, because what happens next will not be decided by predictions. It will be decided by how the market responds to pressure, and pressure is just beginning.